The clock is ticking. Just 15 hours remain before a global bombshell shakes the world, and the effects could be catastrophic. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the world is bracing for impact. Tomorrow morning, a global bombshell will drop, and as you're about to see, the ripple effects could be massive. But before we get to that, markets are tumbling across the UK. The pound is plummeting to new lows. What's driving this chaos? And more importantly, what comes next? Because we've been warning that governments all around the world were going to face the unthinkable. As you're about to see, the UK government could be the first. Now let's head over to Bloomberg, where we picked today's story up with the headline is UK market sell-off deepens with the pound falling to the lowest in a year. And when currencies start to plunge, it's not a good sign for the economy. It has massive impacts on the bond market, the labor market, and all parts of the economy, and puts governments in a position, as you're about to see, to do the unthinkable. While market structure has been strengthened to prevent a crisis of that scale, the government's escalating debt burden is once again a source of concern for investors. And this is a problem because when we look at the UK debt burden, it's still nowhere near what it is in other nations, putting countries like the United States in a much worse position here. So what we see happening outside of our borders, well, it's going to impact us at some point in the future. A former Bank of England policymaker has even drawn parallels to the 1976 debt crisis, which saw the UK government ask the IMF for a bailout. Treasury officials have described the move so far, well, at least with the currency, as orderly. But that's the issue that we're going to be facing in the months and years to come as we see the global economy slow. One of the issues during the pandemic is governments overspent. But coming out of the pandemic, when they should have cut their deficits, cut their spending, they went on to spend even more money, thinking that we're in the beginning stages of a long expansion. Now, as we face global economy slowing down, governments are going to be forced to start to cut their deficits and spending, and that's only going to exacerbate what we see as already an extended recession, possibly even a global depression. The worry is that investors have just lost faith in the UK as a place to put their assets. But is that the issue here? Is it just a matter of fact that people are losing faith in the UK? Or is there another factor that's going on? Let's take a deeper look. While the UK still has lower debt than the US, France, Italy, and Japan, investors say that the sell-off from British assets is a culmination of the country representing all of the worst case scenarios for investors right now, which is persistent price pressures, ballooning government debt pile, and tepid economic growth. But isn't that the same issues we're facing right here at home in the US? Many people believe that an all-Republican government is going to drive massive deficits through huge spending programs. We see that inflation's likely to head higher, at least that's the perspective of many market participants. And what are we seeing in the real economy? Growth is slowing, and we're going to get some major data tomorrow. It's going to shake the world. We'll talk about that here in a little bit. Surging yields also suggest that gilts are having to battle for buyers' attention at a time of heavy issuance and elevated yields globally. And so we start to get some perspective as there could be alternatives. And this is the same issue we're seeing in China. What is a PBOC noted is that money is fleeing out of the country. Why? Because they're cutting rates. And outside of China, there's better places to park your money, not only from the safety of a currency perspective, but in terms of yield. And just last week, we saw a deluge of U.S. government treasuries hit the market, and yield on treasuries, the world's safest asset, have also reverted to multi-year highs. But a small recovery on Thursday signaled that investors were stepping back in. Of course, that is the issue here. We're seeing people believing that U.S. interest rates, particularly on the long end of the curve, need to go higher. They believe the economy under President-elect Trump's second term is going to boom. They think inflation is going to surge, and as a result, interest rates need to go down. But again, as we look at the real economy, what do we see? It's slowing down. And if inflation was to turn higher, we already know that consumers can't afford it. When we look at the labor market, what did we see with continued claims, at least on an issue where we saw non-seasonally adjusted? That number up over 300,000. What we're seeing as the U.S. economy slow tells us that rates ultimately will come back down. But for the moment, if you're looking outside of your country to park money, where would you go right now? Well, you go to the dollar and you go to treasuries. That's the game, and perhaps why we're seeing money flood out of the UK. And that's the analysis of former Bank of England rate setter Martin Wheel, who said that the Labour government may have to resort to austerity. That's a big word that governments do not want to hear right now, to reassure markets that it will address the UK's escalating debt burden if sentiment does not change. And then he's referring to is sentiment on the currency and austerity. That's something I've been warning about, that when we see a global downturn, what's expected is governments are supposed to borrow money and spend it into the real economy to soften the downturn and turn things around. One of the problems is back in the pandemic, governments overspent, and coming out of the pandemic, they didn't get their house in order in terms of their finances. Now they're facing not just a recession, but a prolonged one that could put us right into a global recession. And now what we're seeing based on currency moves is markets are telling governments, you've got to cut spending. This is the worst possible move governments could be faced with. And what we'll do is we'll extend any downturn and make things much worse. But if you're worried about losing money in the markets right now, well, we've got some news for you. Check this out. Here's that mystery trade. This is at the close of business on the 8th. Back on 12/31, our CTA Timer Pro subscribers, we put a buy at open on XOP. We were stopped out on the 8th, up 4.15%. That same trade showed up on Momentum Timer Pro a couple days later. And here you can see the note we gave to our subscribers on the morning of the 8th. We said, raise your stop loss levels. We're a little concerned about the risk here. They were stopped out for a nice 1.42% gain. Now, how can you take advantages? How can you make money like that despite the fact that we're seeing currencies plunge and markets start to move into chaos? Well, every day we look at machine positioning. That's called our CTA Timer Pro. And what we're doing is looking for discrepancies in where machines are positioned and where the markets are at, because what we want to do is have our subscribers buying in before the machines and getting out before they sell. That's what we do every day. Now, from a momentum perspective, we look at all these technical indicators with a proprietary overlay. That's called our Momentum Timer Pro. We give our subscribers all the notes they need with all the trades. You get the reports, you get the signals, you get my opinions on the best trades. We even back tested our reports to validate that they work. We give you risk control levels. We update our trades and returns every week. And right now, you still get that 30-day free trial. I had some people in California said, Steve, I'm being affected by the fires. Can you please extend this? I was going to start trading, but just give me a little more time. You've got it. And on top of that, you can even trade right alongside me. Links in the description below. Grab those, start making some big money, because right now, the people that are losing money, well, that's the banks. As the Bank of England notes, the banks are borrowing a record $51.4 billion in cash from their repo program, and they note it does not appear to reflect stress among lenders. But if the banks are going to the government to get cash, what does that tell you? There's a liquidity crisis brewing in the UK. This is exactly what we saw in the US. Remember, we go back to the recent banking crisis that happened in the regional banks. What was the issue? They were out of money. So the government came in, the Fed said, here's the deal. You can come in and you can use our repo program. We'll call it the Bank Term Funding Program. You give us some of your assets, we'll give you cash. And the Bank of England says this isn't a sign of stress. It's exactly what it is. They just don't want people to realize it. And Thursday's increase in short-term usage of the repo program does not appear to reflect stress among lenders. What it does reflect is they're out of money. And that is, of course, stressful when you're a bank. Usage rose around $5 billion from last week, less than the previous increase, and follows a trend of growing demand last year. And here you can see with that red arrow, the banks are increasingly short of cash. Let's talk about why that is, because the aim is that these repos will wean markets off its bloated balance sheet by reducing the risk that banks cannot access funding when reserves drop too low. So what happens is money's leaving the banking system and the banks don't have the cash. But why is that? Why don't they have the cash? Well, the issue has everything to do with central bankers, because when they lowered rates back during the pandemic, they dumped a lot of debt onto the markets and the banks bought it. Then, in response to that, central bankers said, you know what, we need to raise rates a whole bunch. And what that did for the banks is it caused them to face unrealized losses with their bond portfolio. So right now, the banks cannot sell their bonds without taking a loss. And the problem is that they bought these bonds to back the cash that's deposited in their banks. They have no choice but to go to a central bank, in this case, the Bank of England, to get cash. The hope is, at least from the Bank of England's standpoint, is that money will eventually flow back into the banks when, of course, these programs end and the banks have to repay those cash loans. Problem is, what if they don't? Well, that means QE's coming back and rates are going back to zero. Now, a lot of people don't think that's going to happen, but from the banking perspective, as the economy slows, how do banks actually create money? Well, they do it through lending. And guess what you don't get in a slowing economy? And that's right, it's an increase in lending. But let's turn to our headline story now, as a bombshell is about to drop in 15 hours, and it's everything to do with the U.S. economy and payrolls. As U.S. companies announce fewest hires in 2024 in nearly a decade, this from Challenger, Gray, and Christmas. As they say, job cuts were at 5.5% last year versus 2023. But what comes on Friday? Well, that's the non-farm payroll report, and that's the most hotly watched labor statistic on any given month. Everybody wants to know what the government says about the labor market. They want to know how many jobs are created. But what we're seeing based on the data and continued claims, based on now what we're seeing from Challenger, Gray, and Christmas, is there should be a continued deceleration in jobs created. And for those that are hoping and betting on a big rebound in the U.S. economy and inflation, well, the labor market's about to tell them the opposite's coming. Monthly data from Challenger, Gray, and Christmas showed firms announced plans to hire 769,953 workers last year, the least since 2015. And that's a clear sign of a decelerating economy, one where there is a lack of opportunity because companies hire when there's demand. And when demand is growing and they cannot meet it, they need to hire more staff, more workers to meet that demand. What we're seeing from big companies is saying the demand is getting worse. And job cuts also picked up, with employers planning to eliminate 761,358 positions, a 5.5% increase from 2023. And based on what we see from large companies that are reporting this data, the non-farm payrolls should be minimal this year. But in reality, the government has continued to publish fairly robust numbers. But if our prediction is right, we're going to see Friday be a big disappointment for the markets. And Thursday's report builds on recent data showing moderating labor demand as businesses remain cautious ahead of January's changeover in the White House. And it's absolutely nothing to do with who's president. This is the popular belief right now because companies do not want to come out and admit the truth if they don't understand why demand's slowing. Everybody's been looking for an excuse. We heard this from manufacturers saying, look, as soon as the election's over, everything's going to revert to normal. The media promoted this. Everybody got behind it, except one key person in the economy. Well, that's the U.S. consumer. After the election ended, they didn't come out and spend in a big way. In fact, some data that I'm going to show you here shortly indicates that consumers retrench going into the end of the year, and that is a dangerous sign for the U.S. economy. Let's take a look at what's really going on in the economy, why we're not seeing the labor market booming. It has everything to do with demand and consumption. As we take a look at advanced retail sales adjusted for inflation, or what's called real retail sales in blue, that's shown on a year-over-year rate of change against continued unemployment claims. And what we see going back to the mid-1990s is decelerations in demand, or real retail sales, leads to a rise in continued claims. You see that happen right around 2000. We see a peak here in real retail sales. It starts to decelerate. What happens? Businesses saying, I don't need as many employees. People start losing their jobs. They go on the unemployment line. They get stuck there. And next thing you know, we're squarely right into a recession. We see that effect starting right around 2006, back when real retail sales peaked in 2005. It took a little while for it to impact the labor market, but once it did, well, we were squarely right into a global financial crisis. You can see a slowdown begin in late 2017. The labor market started to adjust to it in 2019, but look what happens now. Real retail sales plunge right around 2022. They go negative, and they're largely negative for 3 years running. What do we see? Eventually, continued unemployment claims bottom. They head higher and they get stuck here, despite the fact that many believe that the economy is going to turn around. But based on what we saw, at least in the non-seasonally adjusted data, over 300,000 Americans that had previously filed initial claims came back and filed for continued claims. That is not a sign of an economy that's creating jobs. What it's telling us, it's an economy where the labor market is starting to unwind at a time when we look at investor positioning. They're betting big on stocks. They're short the bond market. And what that's telling us is they're completely off sides here for what's coming. Because when we take a look at the delinquency rate on credit cards and overlay that against real retail sales, we start to get some perspective that U.S. consumers are completely tapped out. And in order to see a booming labor market and a booming economy, we need to see consumers in spend mode. We go back to 1994. What do we see? Real retail sales fell as consumers got behind on their payments. The credit card companies cut them off. Remember, the American way is to buy things you don't need with money you don't have. And that's why the credit card data here is absolutely critical. In fact, credit data when it comes to consumer spending, as you're about to see, is hugely important. And we saw it change late this year that many weren't expecting. Now let's fast forward to 2006. We see once again delinquency rates are on the rise. It packs the real retail sales once again right into a recession. And look at now, we see delinquency rates are rising, and the rumor on the street is they're going to go up even more. Of course, what we're seeing is a turnaround in real retail sales, at least going into the end of the year that many hope, but in reality it's likely to turn back and go negative, at least based on what we're seeing in the continued claims data, because what is telling us that employers are losing hope. They're not seeing the economy turn around, and that bombshell that drops in 15 hours when that non-farm payroll hits, well, everyone's expecting some big numbers here to show that the U.S. economy is going to lead the world out of this downturn. What we're expecting is it to show the world that we're following them right into a recession. The slower hiring pace reflects ongoing uncertainty in economic conditions and cautious approaches by employers to expansion. And now we get to the truth about this is companies are uncertain about the economy. That's the real issue. It never had anything to do with who's president. It has everything to do with the economy. And companies are saying, look, we're not seeing demand. We're not seeing growth. We're not seeing all the things that we were promised to see. And that means we've got to start cutting expenses. They've done that to some extent, but their biggest expense is labor. And if you have people staying around not working, well, you send them to the unemployment line. And market economic conditions were the most cited reason for job cuts in 2024, affecting about 150,000 positions. But check this out. Cost cutting came in second, accounting for more than 148,000 cuts. Now, why did people cut costs? It's because their revenues are falling. And when that happens, you cut expenses everywhere you can because you want to hold on to your labor, particularly if they're trained. But when they start standing around and you see no new orders coming in and you don't have enough work for them to keep them busy, you have no choice but to lay them off. And companies underwent extraordinary change in 2024 due to rapid technological advancement and shifting economic conditions. So what companies actually did is they saw the economy slowing, despite the fact that they kept bragging about how after the election it was going to turn around, everything was going to be okay, because they wanted people to keep buying their stock. That was one of the key things here. But in reality, they were putting technology in to replace workers. Now we're starting to see those effects. Let's talk about the non-farm payroll report that's going to drop Friday morning. And let's go back. We have to cut out the pandemic years because it skews a chart where we can't actually see it. Let's talk about the relationship between continued claims and the non-farm payroll report. That's shown in blue in terms of change in purses. Now keep in mind, they're completely unrelated reports, but they still give us perspective on the labor market. And what I want you to see is that when continued claims are rising, it tells us that the expectations, at least in terms of non-farm payroll report, is that it should slow down. Let's go back in time here and back into the 70s and look at the relationship. You see continued claims rising in red. What happens? You get a deceleration in the headline non-farm payroll report. You see that repeat in the late 70s, again in the mid 80s. You see it in the late 80s, early 90s, again in 2000, again going into the global financial crisis. Every time you see a slowdown in non-farm payrolls, we tend to see a rise in continued claims. Let's go back to May of 2021, and we try to draw this arrow in to smooth out the report. And what it is telling us is the trajectory of the U.S. economy has been slowing since 2021, despite the fact that people don't believe it. And market participants are betting big the economy is going to boom. They think long-term rates need to go even higher, but they realize that growth is slowing down and inflation is going to come down with it. And we have some major evidence. We now look to the credit markets as U.S. consumer borrowing drops on a plunge in credit card balances. And this is critical because remember, if consumers don't have money, they don't spend. Outstanding credit card and other revolving debt decreased $13.7 billion, the most since early in the pandemic, after surging a month earlier. Non-revolving credit, such as loans for vehicle purchase and school tuition, increased $6.2 billion, according to a recent Fed report. The data suggests consumers are making an effort to pay down credit card balances as borrowing rates remain near a record well above 20%. And Americans have relied more on credit card in recent years to help support spending amid persistent inflation. So what this is telling us is that consumers are tapped out. They realize that they're now got to pay down their credit cards. That means less money going into the real economy, means more Americans on the unemployment line, and inflation is coming down. The Fed's report showed rates on credit cards that charge interest stood at 22.8%. Meanwhile, a 16-month loan from a commercial bank for a new vehicle stood at 7.82, and with money drying up, wage growth slowing, and hours worked getting cut, it's likely that the U.S. economy is going to continue to decelerate, pointing us right into recession at a time when investors are betting big on stocks and short on bonds. They're completely mispositioned for what we see is coming. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.